Sir, payment will only be made after Omega sells the goods to the end customers. I don't think we should recognize the revenue yet.
We need stronger profits this year. Just record it. Sir, shouldn't we have a proper technical assessment before changing the useful lives?
No, just make the changes. It will reduce depreciation expense and increase this year's profit.
Hey, Ahmad, shouldn't we report diluted EPS?
Nah, we're good. Just Showed want to see solid numbers.
I don't know, that doesn't seem right.
Trust me, just roll with it.
Sir, we got a problem. AlphaTech filed for bankruptcy, impacting our receivables.
Leave it out, we can't blow the covenant.
But that's not right.
Look, don't overthink it. Don't overthink it. Just do what I told you.
Man, what am I if I speak up? I could lose my job. There's gotta be a better way. Doing the right thing shouldn't feel this hard.
The first issue that we found in this study case is revenue recognition consignment agreement. In December 2025, NTK delivered a large quantity of goods to Omega Trading Berhad. Omega is only required to pay NTK once the goods are successfully sold to end customer. Despite this condition, the director Ahmad instructed the accountant to recognize the full revenue immediately because physical delivery had occurred, driven by a desire to inflate employee compensation. The justification that using relevant accounting standard is MACAC2403E. Under MACAC2403E, revenue from contract with customers, revenue is recognized only when a performance obligation is satisfied by transferring control of a promise or of a promised goods or service to a customer. This transaction exhibits the characteristic of a consignment arrangement. Physical delivery does not equate to the transfer of control. According to MACAC2403, control has not transferred because the recipient Omega does not have an unconditional obligation to pay, and NTK still controls the good until a sale to an end customer occur. For the assumption, estimate and professional judgment, the accountant must prioritize the economic substance over legal form. The risks and rewards along with the right to direct the use of the inventory remain with NTK until Omega execute a sale to end customer. Since no end customer sales were reported before 31st December 2025, zero revenue should be recognized for this transaction in the 2025 financial year. Impact on financial statement. There are two impacts. Firstly, overstatement of trade receivable. Trade receivable are overstated while closing inventory is understated. Then, impact on covenant. This manipulation artificially drops the debt to equity ratio by inflating equity via retained earnings, misleading Zenith Bank regarding compliance. Issue 2 is about earnings management through change in useful life. The second issue concerns the sudden revision of the useful lives of high-value manufacturing asset at the end. Ahmad ordered this change without a proper technical assessment or objective engineering justification. We justified using relevant accounting standard is we use MFRS 116 and MFRS 108. MFRS 116, property, plant and equipment, mandates that the useful life of an asset must be reviewed at least each financial year end. If expectation differs from previous estimate, the change must be accounted for. However, under MFRS 108, accounting policy change in accounting estimate and errors, change in accounting estimate must be based on reliable, fresh information or new developments. The change without technically basis violate the representationally faithful requirement of financial reporting. Next, for the assumption, estimate and professional judgment, the management has the authority to make estimate, but they must be grounded in objective reality. For example, physical wear and tear. Since there is zero technical justification provided, the extension of useful life is assumed to be an act of earnings management designed solely to depress the depreciation expenses. The financial statement impact is understate depreciation expense, which directly overstates the net profit and overstate the carrying value of non-current asset on the statement of financial position. Moving on to issue number 3, which is incomplete earning per share disclosure. NTK issue the convertible debt to fund its new investment project. Ahmad omitted comprehensive disclosure and skipped presenting diluted EPS under the personal assumption that the debt would not adversely affect the EPS. Justification that made by standard by FAR513 earning per share states that entity must present both basic EPS and diluted EPS with equal prominence on the face of the statement of profit or loss. Convertible debt is a compound financial instrument containing potential ordinary shares. Under MFRS 133, the entity must calculate and present diluted EPS to show the potential reduction in earnings per share if debt holders exercise their conversion options. Omitting this information directly violates mandatory presentation and disclosure clauses. Assumption, estimate and professional judgment. Management and personal confidence regarding dilution does not override structural accounting standards. It must be assumed that the convertible debt is a potential dilutive instrument unless mathematically proven otherwise. Therefore, the impacts on financial statement, the company would having a serious omission of vital disclosure information which mislead potential investor regarding the future dilution risks of the equity investment. The final and most critical technical issue is omission of an adjusting post-balance sheet event occur just prior to the authorization of the financial statement. NTK's major client Al-Fatah Berhad declared bankruptcy, threatening the collectible of NTK's receivable. Ahmad ordered this information to entirely excluded from the financial records to hide the financial damage from Zenith Bank. The accounting standard justification and evaluation using by accounting standard MFRS 110 events after the reporting period classify event occurring between the end of the reporting period and the date when the financial statements are authorized for issue. The bankruptcy of a major customer after the reporting period usually confirm that a condition of loss existed at the end of the reporting period. Therefore, this is an adjusting event. Furthermore, under MFRS 9, financial instrument, the expected credit loss model require the carrying amount of trade receivable to return down via an impairment loss immediately when a clear evidence of uncollectible arise. Assumption, estimate and professional judgment, which is the professional judgment must be used to recognize that hiding a material adjusting event to satisfy a bank covenant is fraudulent financial reporting. The outstanding receivable balance from Alpha Tech must be assumed to be largely uncollectible. And then lastly, impact of the financial statement, which is understatement of expenses. Means impairment or bad debt losses and overstatement of net profit. Then the second impact is going concern risk. If properly adjusted, the loss would reduce equity, causing the debt to equity ratio to exceed the 50% limit. This triggers Zenith Bank rights to demand immediate repayment of the entire loan, directly threatening NTK's going concern status and business survival.
Assalamualaikum. My name is Nurul Aisha Shafawati. Today I will presenting the ethical evaluation and reflection using the ADAPT framework, specifically looking at OTUR3 and NIAMN. First, I will explain regarding the ethical issues arising from the financial reporting decisions made by the Director Ahmad under OTUR3 framework. For observe, Ahmad instructed immediate revenue recognition, although the sale did not satisfy the revenue recognition requirements. He instructed Alia to revise useful lives without technical justification. He omitted material information such as Alpha Touch bankruptcy and disclosed only basic EPS to present a stronger financial position. For management pressure and performance targets, Ahmad wanted to maintain the loan covenant, increase the EPS, secure the investment project, and maximize employee compensation. When we think, these actions intentionally misstate the financial statements. They prioritize personal and company short-term interests over truthful financial reporting. Stakeholders such as investors, lenders, and shareholders may make wrong economic decisions. We understand that Ahmad breached integrity, accountability, and professional responsibility. The financial statements no longer provide faithful representations. His action conflict with the other principles of honesty, justice, and moral responsibility. We must remember, financial reporting must comply with MFRS regardless of management pressure or financial targets. Ethical leadership requires directors to act transparently and protect public trust. On reflect, Ahmad should have recognized revenue correctly, disclosed all material information, and used proper technical assessment. Decisions should prioritize ethical conduct instead of meeting performance targets. For remorse, Ahmad should acknowledge his unethical decisions, correct the financial statements, and strengthen ethical governance to prevent recurrence. Moving on to Ahmad's and IAMN analysis, for Niat, Ahmad's intention was to improve reported performance, satisfy the loan covenant, and increase EPS rather than present fair financial statements. His ikhtiyar, he deliberately instructed aggressive accounting treatments and omissions of important disclosures to achieve those objectives. For Amanah, Ahmad breached the trust placed in directors by shareholders, lenders, and investors. For Muraqabah, he failed to exercise self-control and ignore his ethical and professional accountability despite knowing the reporting requirements. The natijah, misleading financial statements will lead to loss of stakeholder confidence, risk of legal and regulatory actions, and damage to anti-case reputations. Moving on to the ethical dilemma faced by the accountant Alia under the OTUR3 framework. First, observe. Alia realized the accounting treatments were inappropriate. She was instructed by Ahmad to follow the adjustments. For management pressure, she was still on probation and feared losing her job. When we think following management instruction would result in misleading financial statements, refusing may threaten her employment. We understand Alia faced an ethical dilemma between professional responsibility and obedience to management. There is an ethical conflict between compliance with accounting standards versus complying with her director's instructions. We must remember, professional accountants must uphold integrity, objectivity, and professional competence regardless of intimidation. On reflect, Alia should have raised her concerns, documented the issue, and sought guidance through appropriate reporting channels. For remorse, although under pressure, she should recognize that compliance with ethical principles is more important than protecting her positions. Now, let's review Alia's and IAMN analysis. Her niyat, Alia intended to keep her job and avoid conflict rather than deceive stakeholders. Her ikhtiyar, she complied with Ahmad's instructions instead of pursuing ethical alternatives such as consultation or escalation. For Amanah, as an accountant, she had a responsibility to prepare reliable and truthful financial statements. For Muraqabah, she recognized that the accounting treatment was inappropriate but allowed fear of management pressure to influence her judgment. The natijah, financial statements become misleading, stakeholders may rely on inaccurate information, and Alia may face professional disciplinary action despite acting under pressure.
Hi everyone, I am here to present our recommendation to address and resolve the ethical issues identified at NTK Corporation based on our regarding revenue recognition for Omega Trading. NTK should recognize revenue only when the control of the goods has passed to the customer according to MFRS 15. Since Omega will only pay after selling the goods to end customer, the transaction is likely a consignment arrangement. By using the OTUR3 mechanism, Alia should observe and think carefully before recording the revenue. This will help her distinguish between the right and wrong action instead of manipulating the financial statement to meet the loan covenant. Second, concerning assets' useful lives, NTK should reverse the change in the useful life of the asset until a formal technical assessment is carried out. This shows integrity because accounting estimates should be based on evidence, not management pressure. Through moral mindfulness, management should realize that honest reporting is more important than reporting higher profits. Third, for transparency in EPS, NTK should disclose both basic EPS and diluted EPS as required by MFRS 133. This gives investors complete and transparent information about the possible effect of the convertible debt on earnings per share. This reflects the principle of amanah, where the company provides a true and fair view to stakeholders. Fourth, regarding the Alphatech bankruptcy, this should be treated as an adjusting event under MFRS 110 because it affects the collectibility of receivables. The company should update the financial statements to reflect the actual financial position. This shows amanah and honesty towards the bank, investor, and shareholders. Lastly, to support Alia's professional courage, she should invoke her conscience by using the OTUR3 mechanism to recognize that the instruction is unethical, instead of simply following Ahmad's instruction. She should recommend her concerns and seek advice from the audit committee or higher management. This allows her to move from the self-consciousness to self-governance, where she chooses to do the right thing even under pressure. In terms of governance and internal control improvement, the audit committee should play a more active role in reviewing important accounting decisions and ensuring they comply with MFRS. Besides reviewing reports, the committee should promote moral mindfulness so that accounting decisions are based on professional judgment rather than management pressure. Second, NTK should establish a confidential whistleblowing system so employees can report unethical behavior without fear of punishment. When employees invoke their conscience after receiving an unethical instruction, they should have a safe channel to report it. This also reflects the muraqabah principle of being accountable for every action. Third, employee bonuses should not depend only on short-term profits. Instead, performance should also be measured based on ethical behavior, long-term sustainability, and compliance with accounting standards. This reflects the natijah principle by focusing on long-term consequences of decisions. Next, regarding measures to strengthen professional integrity, NTK should organize regular ethics training using the OTUR3 mechanism. This helps employees practice identifying ethical issues, invoking their conscience, and making the right decision before facing real workplace pressure. Next, the company should encourage employees to move beyond following rules because they are required. Instead, they should develop self-governance where they choose ethical behavior because it has become part of their personal values and professional responsibility. After all that I have been discussed just now, we can conclude that NTK should encourage all employees to apply the NIAMN values in their daily work. First, employees should prepare financial statement with the sincere intention of presenting a true and fair view known as NIAT. Second, they should make every effort to apply MFRS correctly, even when facing pressure from management, known as ikhtiar. Third, they should carry out accounting responsibilities honestly to protect the interests of shareholders, investors, and the public, known as amanah. Fourth, they should always be aware that every accounting decision has ethical, professional, and spiritual consequences, known as muraqabah. Finally, they should consider the long-term impact of every accounting decision on the company's reputation, stakeholder confidence, and business sustainability, known as natijah.
To formally address our first objective, which is preventing the recurrence of reporting failures, we focus on mitigating executive caution. We must first diagnose the operational vulnerability that allowed these crises to manifest. What we saw at NTK was a severe asymmetry of power. Senior management actively used intimidation tactics against Alia, leveraging her vulnerable probationary status to force her compliance. To eliminate this vulnerability, our proposed structural shield is the implementation of a legally protected, completely anonymous whistleblowing channel. By granting absolute immunity from executive retaliation, we completely strip rule management of their leverage over subordinates. But structure alone is not enough. We must also arm our accounting personnel with an internal cognitive framework. We propose institutionalizing the OTUR cycle directly. As a practical mechanism to train and refine conscience, we train staff to systematically observe, think, understand, reflect, and also remember. Through this, basic self-awareness progresses into robust self-governance. If mistake or pressure happen, the professional triggers the ultimate stage of remorse, protecting them to self-correct and also confidently reject non-compliance directive before they ever hit the ledger. Moving on to our second requirement, we look at institutionalizing independent governance to ensure continuous compliance with Malaysian Financial Reporting Standards, MFRS. The root governance breakdown at NTK was a glaring control deficit. Unchecked executive authority allowed Ahmad to unilaterally revise asset useful life and intentionally suppress material subsequent events, all just to artificially protect the Zenith Bank loan covenant. The other module explicitly reminds us that while corporate governance requires stringent rules and codes of best practices, these external rules fail if individuals lack inner disciplines. This control deficit, our governance framework introduced a strict mechanism shown in our diagram, mandating independent internal audit verification for all high-value adjustment to accounting estimates. As illustrated, this action directly serves to prevent future crises, protect vulnerable stakeholders, and systematically build authentic market trust. Furthermore, we must change how the regulation themselves are viewed. Moving forward, MFRS standards must be enforced as rigid, non-negotiable legal parameters rather than flexible, negotiable management choices. Under this framework, critical economic realities such as Afatec, bankruptcy are handled exactly as they should be, as non-negotiable adjusting events that must be transparently disclosed. Next, let's look at our third requirement, which is promoting ethical financial reporting through shifting to values-driven reporting. As the module defines it, ADAP is an inner discipline deeper than ethics. To reference Prof. Dr. Fauzia Muhammad type frameworks, ethics is what you do when no one is watching. ADAP is what you are when no one is watching. First, we address the purification of professional intent through the principle of niyat and ikhtiar. When an accounting team realigns their niyat and ikhtiar, the organization's daily operational goals shift away from creative earning manipulation and refocus entirely on the precise, objective discovery of financial facts. Second, we instill the concept of amanah, which is trust, and muraqabah, the awareness of ultimate accountability. These recontextualize financial statements. They are no longer a number on a page. They are a sacred fiduciary trust owed to our lenders like Zenith Bank and the wider capital markets. Through this ADAP framework, professional integrity ceases to be static, external checklist, and transformed into an intrinsic corporate value driven by more mindfulness. Finally, we reach the climax of this reflection on our strategic outcome, which is evaluating financial realism versus systemic collapse. Here we look at our natijah, or ultimate consequence of our strategic choices. The ADAP framework instilled a strong conviction that every professional action carries inescapable consequence. NTK faced a classic strategic dilemma. Ahmad believed that suppressing economic distress would artificially protect their short-term governance. However, as our flowchart demonstrates, masking reality invites a domino effect to institutional risk. Uncovering material misstatements later triggers immediate loan acceleration, severe regulatory penalties, and potential corporate liquidations. The ethical resolution and the ultimate strategic outcome is choosing transparent financial realism. Even if telling the truth temporarily dampens short-term earnings per share figures, it is the only protective mechanism that safeguards the company's going concern status, prevents systemic collapse, and secure permanent market trust and operational longevity.